Yeah, hi, I'm Rachel White from Missoula, Montana. And during the lunch break, I heard some people talking about double taxation and how that impacts Berkshire's investment philosophy. So I was wondering if you could talk a little bit about it. I'm not sure I understood it. And if you could explain whether that impacts your investments.
Well, we are structured very poorly. And if you were looking, if you're going to start all over again and do most of the things we've done, you'd probably not do it in corporate form or precisely like we do it. I mean, what that gentleman was talking about in connection with McDonald's applies much more to Berkshire Hathaway, even by far, than McDonald's in terms of detaxing part of the income stream. If we own Coca-Cola with a cost of $1.2 billion or $1.3 billion and a market value of $15 billion, we're not going to sell it. But if we did sell it, we would incur a capital gains tax on the order almost of $5 billion. That means that the 15 becomes 10 billion. Now, if that 10 billion is reflected in Berkshire's value and you bought your stock when we bought our Coke, then you pay a second tax in turn in reflection of the Coca-Cola appreciation that's taken place after tax. So it's a very disadvantageous way of owning securities to have a corporation in between you and the securities themselves. If we ran as a partnership, that would not be the case. I ran Buffett Partnership for many years, and we only had one tax at the individual level. So our stockholders are, to the extent that we own marketable securities, and we own a lot of them, and to the extent that we have a lot of profits over time in those, own those securities in a disadvantageous way. Now, we also have a float, which helps us own them, which is a big plus. But corporate ownership of securities, if you have the option of owning them directly or through a partnership, corporate ownership is disadvantageous, and we're stuck with it. We've had it for all these years. We've got no plans to do anything about it. We couldn't probably do anything about it if we wanted to. So that is a drag on our performance compared to what would be the situation if we operated as a partnership. And Lloyd's syndicates, for example, didn't have that problem. Some insurance companies that operate in Bermuda may not have that problem to the same extent. Certainly partnerships don't have that problem to the extent they own securities. But it's a fact of life with us, and we're going to pay a lot of taxes. Charlie?
No, we have no cure for the corporate income tax, and it is a big disadvantage for the indirect owner of securities. So far, we've surmounted it well enough, but we're carrying a load there.
It's become a bigger disadvantage since the individual rate went to 20%, with our corporate rate being 35%. Because if we make $1 on a stock, it becomes 65 cents, and to the extent that you've owned Berkshire, that 65 cents now 20% off that becomes 52 cents, whereas if you'd owned the stock directly, you'd have had 80 cents. Now, when we owned Geico and it wasn't consolidated with us, you carried that one more extreme. I mean, Geico had capital gains, and we had a capital gain proportionally in Geico, and so on. I mean, how you're structured does make a real difference, but usually once you get into a given structure, you're kind of stuck with it, as I indicated in the answer to the gentleman on McDonald's.
Now, to the extent we have very long holding periods at the corporate level, the real mathematical disadvantage shrinks.
Yeah, and we might not have been able to get the float that we have if we hadn't been operating it in a corporate structure, so that is a mitigating factor too. But we like to have the mitigating factors without anything to mitigate if we get our choice. Area 9, please.